ahead on Money Life and apparently for the stock market.
Historically, when equities are at this valuation, when they're trading this high in price, that predicts lower future returns. Not necessarily negative, but certainly lower than the average that investors have come to expect. So I think valuations make it hard for us to see much more upside from here in the U.S. market.
That's Philip Wool, Chief Research Officer and Lead Portfolio Manager at Rayliant Global Advisors, who gives his take on international markets, stick with them, the economy, stick with it, but expectations, lower them. But we've also got Ryan Jacob, Chief Investment Officer at the Jacob Funds, here talking stocks and AI names particularly in the market call. Plus, a year ago today, my friend Jonathan Clements was on the show discussing his cancer diagnosis and how he intended to live out his life. He has indeed lived out his life, and we'll take time for a tribute to him today.
It's sock it to me time.
Welcome to Money Life for September the 23rd. I'm your host, Chuck Jaffe. Shana Tova for all those of you who are celebrating Rosh Hashanah, the Jewish New Year. I celebrate, but I don't necessarily stop myself from working. So, yeah, we've got a lot of that going on too. But this is still going to be an upbeat show in spite of the fact that we are taking time to memorialize Jonathan Clements. Jonathan was on this show literally 1 year ago today, an interview that was tremendous that I encourage you to go find it in our archives. And he had lung cancer. He knew that this was coming, et cetera. He prepped. You should go to Humble Dollar and see what he had planned to write there. Humble Dollar being the website he started after a long career at the Wall Street Journal and doing other types of financial journalism. And I will explain, Jonathan and I had a relationship over many years. We've known each other for decades. We were kind of competitors and what have you. But as we got to know each other better over time, we became very friendly. And he was an amazing guy. And I'll cherish that last conversation. And literally was doing stuff this week and going, yeah, he would have approved of it because of a clip that I'll play for you in that interview. So you get older, you lose heroes, you lose friends, you lose whatever, and it doesn't make it any easier. But Jonathan very definitely wanted his story to be told and wanted lessons to come from it. And so we will tell those lessons. And that is the way we can celebrate his life, which, much like my brother who died at age 57, Jonathan, 62, is able to say, it may not have been as long a life as I wanted, but it's been a good one. And he was very clear about that. And make the most of your time because it's not guaranteed for any of us. Philip Wool, really good interview, talking about valuations, talking about how he thinks that we can avoid recession, but also an interesting take on international versus domestic, because we definitely have this dichotomy of folks, some saying international's played out, others saying, no, you can't say it given valuations. So you'll get his take on that and more. And Ryan Jacob, who was a star mutual fund manager when he was the manager of the first ever internet fund, he is back on the show today. And you're going to hear people make comparisons, rightly or wrongly. In fact, you'll hear me talk a little bit about it with Philip Wool about the modern day AI stuff compared to the internet bubble. And I will point out that many, but not all of the current companies have profits, and the internet companies back in those days really didn't, and that the market has changed. And Ryan makes some really good points about this, but I kind of figured it was good to get him talking about those issues as well. So that's our show today. We're going to jump right into it. One last reminder, you can reach me at chuck@moneylifeshow.com. We had an issue where yesterday's show was up, but not in every podcast channel. If you don't find our show on a weekday when the market is open, please send us a note because we don't always check that stuff. It all looks normal. We find it in the places we are seeing it, and we don't necessarily see it where you would normally find it, and therefore we don't know that it's missing. Please tell us, DA in Honolulu, let us know yesterday. We appreciate that. But also tell us what you want that we can do to make this show better for you. chuck@moneylifeshow.com is how you reach me. That's also how you enter our contest that we've got going this week. Stick around. Rob Floyd will tell you about that before we get to the last segment of the show. That's it. Let's go. I've told you what's coming. The talk starts with me remembering Jonathan Clements right after this message.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
It may seem a little odd as this segment goes on for us to have played upbeat music to start it, but my friend Jonathan Clements wouldn't have wanted anything else, because all the way till the end, he was upbeat. He was remarkable. And he passed away on Sunday night. And there are a number of tributes that are coming out, which they should be coming out, because Jonathan Clements, for those who don't recall the name, Jonathan Clements for a long time was the Getting Going columnist at the Wall Street Journal. And you didn't have to be a Wall Street Journal reader to see his work, because the Journal did a section that appeared in 70 newspapers across the country. And Jonathan is a very interesting touch point for me personally for a lot of reasons. So his passing hits hard and is a reminder of things to do. And it does that for a few reasons. So I'll start up front. One, Jonathan and I are basically the same age. He 62, was born in 1963. I am 63, so I'm 6 months older than him. He became the Getting Going columnist for the Wall Street Journal at age 31 in 1994. That's the same year I became the personal finance and mutual funds columnist at the Boston Globe. For a long time, I considered us competitors, even though he had the Journal and the Journal's audience, and I had syndication and a much more blue-collar audience, but then the Journal had its syndication deal. So inevitably, I was competing. I was places where they were saying, well, should we buy your column, Chuck? We're getting the Wall Street Journal section, so we've got Jonathan Clements. We took different approaches to what we did, because Jonathan became probably the preeminent advocate other than Jack Bogle for index investing. He was out there banging the drum constantly. So much so, by the way, that Brill's Content, a magazine that doesn't exist anymore, once basically said you could track Jonathan Clements, that he had said there were only 26 ideas for personal finance and you just would repeat them every 6 months. And then they tracked him and found out that he was writing about the same things a lot more than once every 6 months, especially when it was use index funds, know your asset allocation, allocate to them, and go. We also, in some respects, were competitors, because you'd see us writing on similar subjects in similar ways, and you'd go, wait, did he get credit for writing that? And I wrote a similar thing and nobody noticed or whatever. You could sense some professional jealousy. And we had never met for a long time. And then we did meet, and we realized we're similar guys in similar ways. Maybe a slightly different approach. Jonathan was happy to tell you he felt his way was right in terms of what he was doing. I tend to be more go find the right way for you. But both of us trying to get people to handle their finances and do things. And Jonathan died of lung cancer. Mind you, he never smoked. He was a very fit guy. He ran, he biked, he did a lot of those sorts of things. We had him on the show 1 year ago exactly today. Jonathan Clements was on the show a year ago today. At that point, he knew that his fate was sealed. And we had a warm, open, honest discussion about so many things, of which you heard something like 24 minutes. But he and I talked a little bit more around those things. So I want to play just a little bit of Jonathan, because here's a guy who, he took different career paths than I did, but he amassed a lifetime of savings, which allowed him to live the life he wanted. And knowing that my own brother died at age 57, 15 years ago, one of the things my brother said at the time was, I got to live my life without regrets. We can all have personal regrets, et cetera, but on the big things about what you're doing. And so Jonathan pointed out that he was asked about regrets all the time. Like, you saved all this money and now you're not going to live long enough to use it all. Here's his answer on regrets when it comes to money. Because for all of you who are saving, But I also think back to like Rich from Orchard Beach, Maryland, big fan of this show, who died earlier this year, who had amassed a lot of money and was talking about how he didn't spend it all. He was struggling to go from saver and accumulator to somebody who was spending it. I want you to keep this perspective because it made Jonathan's life better, and I think it would make yours better too.
Do I regret amassing all that money? I mean, I've had this question countless times in recent months, and the answer is no. I'm more than happy to ensure financial security for my kids and for my wife. But more important, amassing all that money over the years and getting to the point where I am financially independent has given me a sense of financial security. So even though I haven't been able to spend that money, I have, for the past couple of decades, been able to live without worrying about the money. And I've essentially been able to lead the life that I want.
Now, one of the things that Jonathan did that I think will be one of his legacies is that he talked about dying. He wrote extensively about illness and his impending death. And I probably have buried this, but Jonathan created humbledollar.com. And that website will outlive him, but you should go there to see. He wrote a piece that was aimed to be posted when he passed. That went up on Monday. You should also read Jason Zweig's obituary of Jonathan Clements. But Jonathan said on this show a year ago how he wanted to get the most out of every day. Jonathan was fortunate he had 2 grandchildren. And I should point out, in similarities, Jonathan met his wife, Elaine, his third wife, during the pandemic. They were getting married in 2024, right around the time that he got the diagnosis. Gail and I met 6 months before the pandemic. We got married at the end of 2023. So we met 6 months beforehand. We got married 6 months before he did. But Gail and I have talked about things that we need to do and that we want to do. And some of them are things about our lives, and some of them are things that are about our families and trying to make sure that we do the right thing when it comes to them. And I was cleaning up the other day and I got rid of some old things, and I need to get rid of a lot more old things. But I was thinking about this with Jonathan. And again, I will encourage you to listen to his words, but then implement them to some extent in your own life.
Every day since I got my diagnosis, I have been doing something to make it easier for Elaine and my kids after I'm gone. I thought I was well organized, but not nearly as well organized as I imagined. I am still finding stuff in the basement to throw out. I just got through a couple of huge boxes of letters that I've been dragging around for 40 years. Some of the letters went back to when I was in college or the early days of my career. Why did I keep all this garbage? I have no idea. But the thing I say to people is, if you leave behind this stuff, if it's a lot of stuff, your heirs are going to say either it's too much to look at, I'm going to toss it out, or wow, Dad kept this. It must have been really important. We better take a close look.
If you hear that and it doesn't motivate you to try to do more when it comes to preparing for your family, you're missing something. It's a burden we don't want to leave our loved ones. But as I pointed out to Jonathan in the interview from a year ago, and you can go to moneylifeshow.libsyn.com, or you can go to our show page at moneylifeshow.com to find our archives, but the archives are at moneylifeshow.libsyn.com, Libsyn. You can search for that show and go back and listen. I asked Jonathan, he talked about clutter and a bunch of things that he had. And I said, but wasn't it fun to go through it? Like, didn't you have a blast? He's like, I had fun with some of it, but mostly I'm glad that I got rid of it. And he goes, oh, by the way, there was stuff there from like my 19-year-old self that I'm glad my kids didn't find because they would have thought I wasn't such a nice guy. And as we lead our lives, we collect a lot of things, many of them not financial, and we collect them for reasons. I know with the last flood, there were some things that I said, I've got a bunch of old clips that I just haven't looked at for ages. I'm never going to need them again. I don't need them to prove to somebody, hey, I've been a published writer. And getting rid of that stuff is very freeing. I have plans to get rid of things. I've got ideas on getting rid of things, but I haven't done it. And yet it does feel very freeing. And you want it to be freeing because you want to be able to approach the end of your days, whenever they come, with a sense of freedom. Jonathan did a lot to leave a legacy. A compendium of his columns in the Wall Street Journal called The Best of Jonathan Clements was published earlier this year. Proceeds from that book go to support the Jonathan Clements Getting Going on Savings Initiative, which is a collaboration between several different nonprofit groups, all trying to make it that young people from low-income households become long-term savers. It's a tremendous effort. If you liked Jonathan's work or admired it or just want a great book of very readable things, go and find The Best of Jonathan Clements. It's worth doing. But Jonathan's attitude in facing what he was facing was also remarkable and a great reminder of how we should value our time and what we should do. And without revealing other details, I have family members who have been struggling of late with a number of things because, life is piling stuff up on them. Yet in the middle of having things piled up on them, Jonathan served a great reminder to us last year on this show of how you want to spend your time.
We spend too much time getting caught up in the hassles of everyday life, worrying about stupid stuff. Take the moment, think about, what would happen if this was the final week or the final month or the final year of my life? What is it that I would focus on, and is it that I wouldn't focus on? Because it's a great exercise to go through, and probably what you'll find is there is a lot of nonsense that you focus on every day that you should simply toss out the window.
If you want to learn more about Jonathan Clements, go to humbledollar.com. He's written several books. I didn't even discuss any of those here. They are all worthwhile, worth looking at. My Money Journey, a book that he did with his colleagues from Humble Dollar. Distinctly interesting book that we discussed on the show. You could go find that in our archives as well. But you can learn more by going to humbledollar.com. He has made sure that that site will be part of his legacy and that it will live on. They have, Elaine, his wife, was going to continue it, but she has basically picked a member of that community to run it as she pushes forward, and you can understand that. But it's going to continue existing, and it's going to continue being vital, and it has been vital throughout the time where Jonathan was sick. So you know that that is going to continue, and Jonathan's legacy will continue as well. And mostly I'll miss him. The occasional conversations we had were always days that were good days, because that was the way Jonathan was before he got the diagnosis and after the diagnosis. And we should all be lucky enough to live a great life and leave a fabulous legacy. And Jonathan Clements did just that. Back in a flash with more Money Life.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
Welcome to the big interview on the September 23rd edition of Money Life. Joining me now, Philip Wohl. He is Chief Research Officer and Lead Portfolio Manager at Rayliant Global Advisors. When you're talking about Rayliant, you're talking about international investing. It might be best known for the Rayliant Quantamental China Equity ETF. That's RayC. But you can learn more about all the things they do at Rayliant, Rayliant, Rayliant.com. Philip Wohl, welcome back to Money Life.
It's a pleasure to be here, Chuck.
With a lot of the guests on this show, I don't necessarily start with the international side. I start with the domestic side. But given your focus at Rayliant, international booming this year, but I have had plenty of managers who have come out and said, yes, the international rally keeps going and things are good. And I've had pretty much an equal number who have said, nope, that rally's now played out and we're going to see domestic go back into the lead. So what's your broad take on where international markets are right now?
So I think it's certainly a year that proves U.S. stocks are not the only game in town. A lot of investors that I talk with, they have an equity home bias. So they're U.S. investors. They put most of their money in U.S. stocks. And that's done really well for them over the last decade and a half. But this year, U.S. stocks have underperformed international. If you look at the S&P 500 year to date, it's up about 13%. Emerging markets have done more than double that. They're up about 28% year to date. The question then becomes, is there still time to participate in international stocks? Is this a time, if you've had some money allocated to international, to emerging markets, should you take profits? And I would argue that when I look at valuations, when I look at risk in the US, and I look at those sorts of characteristics internationally, this is not something that's played out. There's still room for this international outperformance to continue.
How much have we not seen the impacts of tariffs and trade wars internationally? Because we've seen them to a small or moderate point domestically, but we haven't seen the impacts that we thought we would see to this point. There's a lot of people who say they're starting to show up in numbers now. Is the same thing happening in international markets? Are you worried that the tariff effects haven't shown up yet?
So that is one of the key factors that explains international outperformance. There was an expectation even before President Trump was reelected that tariffs were going to be a huge challenge to global growth, but they were going to hit particularly hard internationally, where you've got a lot of economies that depend on exports. And then, of course, we took another leg down in some of these international markets around early April when we had Liberation Day. Those markets have rebounded massively since then. And it's because what we've come to realize, this was the whole taco trade, you can't take those tariff threats at face value, that the administration always has room to delay and defer and to renegotiate those trade deals. And so ultimately, there's a face-saving off-ramp from a trade war for everyone involved. And so what we've seen is that recognition. And I think when we get these periodic shocks in terms of some new policy announcement, investors now rightly regard that as a potential to buy some of these cheaper markets on the dip. And I think that in the US, sort of along the same lines, there was an expectation that we would get a lot of inflation. That didn't happen, in part because there are policy lags and it takes time to actually implement tariffs. And then you have all this uncertainty about what the number is actually going to be. But I do think this is going to contribute inflation, and we're going to see it over time. So, there, maybe we haven't seen the full effect, but investors are kind of discounting it too much.
How much do you worry about the potential for a trade war? We haven't seen it, but we've seen signs of it. We've seen things like China's response to tariffs on soybeans has been, we're not buying any soybeans, and some things along those lines. And at some point, given where we've been, there could be significantly more retaliation. How much do you worry that the fine line that we're walking between we'll impose tariffs and we'll go all out trade war is one that we can stay on?
It's certainly a tail risk. I tend to believe the probability of an all-out trade war is low because President Trump does seem responsive to what's happening in markets. And so I think if we ended up in a trade war with China, say, the impact of that economically, but particularly in the financial markets, would be so extreme that I think that would be an opportunity for President Trump to walk some of those threats back, and we would end up finding a way out of it. But I think the real risk of trade policy and the way things have been going is that it's just very disruptive to decision makers, businesses, consumers. They have trouble operating under this kind of uncertainty. And so I think the ultimate effect is going to be more inflation at home, a drag on growth domestically. And so, those are consequences that I do worry more about than a full-blown trade war.
I believe it was on Rayliant's website where I saw a piece, and I don't know if it was by you or one of your colleagues, that was talking about how maybe we should stop thinking of trade deficits as a loss, and we should instead think about, wow, we're doing so well, we need to outsource stuff. Is that a perspective that can work given what's going on, or is that just wishful thinking?
No, so that was actually a piece that was written by our founder and CIO, Jason Su. And I think that really captures our house view that, but it's not just Rayliant. I think that's sort of the conventional wisdom among economists, among academics and a lot of free market investors, is that trade is a great thing, that it tends to benefit everyone on average. I mean, there are certain industries in the US that have gone away and people that have been displaced and had to readjust and learn new skills. But I think the view is that trade ultimately just expands the pie for everyone. And it certainly creates opportunities for investors. When I think about emerging markets where there's so much growth potential as the US outsources all these things that Americans don't want to do, it's a shame to see that disrupted, because I think there's an opportunity for American investors, and that's everyone in America. Everyone's got their pension in equities. There's a chance to really take those opportunities in global markets as other countries get into the supply chain and really expand with the global economy. So I think there's, that's a view that hopefully we've got some bumps in the road, but hopefully we go back to that sort of global expansion and trade and cooperation.
Let's bring this back to nearer shores. I mean, this has been a Teflon market. It has survived absolutely everything. And it seems that now we're going to get rate cuts, which might be a benefit, though it's hard to tell if we're going to see the full benefit from them. What is your take on how long the domestic markets can roll? Is this just about as long as earnings are good, the market's good?
Yeah, well, look at valuations. I like the Shiller CAPE ratio, cyclically adjusted PE, and we're at levels now that we haven't seen since the peak of the dot-com bubble. The CAPE ratio is at about 38 times. That is historically about 3 standard deviations above the mean, and that's looking back at 150 years. Maybe it's not reasonable to go back that far because the U.S. economy is transformed and supports higher growth. But even over the last 20 years, we're about 2 standard deviations above the average. Doesn't mean the market's going to crash tomorrow. So I don't have any ability to time when this starts to unwind. But historically, when equities are at this valuation, when they're trading this high in price, that predicts lower future returns, not necessarily negative, but certainly lower than the average that investors have come to expect. So I think valuations make it hard for us to see much more upside from here in the US market.
But as you pointed out, that doesn't mean we're necessarily going to see a downturn or recession, et cetera. Where are you on recession odds? Because we've been through the ringer this year when at the beginning of the year, recession seemed unlikely. On Liberation Day, recession seemed highly likely to a lot of people. Now it seems to be unlikely again. Is there a catalyst in your opinion? Okay, we're saying valuations can't get higher, but they keep going higher. So what is the catalyst we're looking for? And is it we just have to have a blow off so we can reset? Or is it we have to have something big like the end of the dot-com bubble?
Yeah, so that's tough to predict. As I said, I think the recession risk is lower because we started from a very strong position in terms of the US economy, because the Fed does have a lot of room to ease. I think the big risk is that word that keeps coming up again and again, stagflation. And that puts the Fed in a tricky position because they're in a situation where it's not alarm bells ringing, but some early warning signs, some weakness in the labor market. And we're seeing inflation not surging again, but it looks like it's sticky and it's, 3% versus the 2% target. That just makes it harder for the Fed to operate. They're trying to determine how much of that is transient, how much of that is going to be persistent, what is the ultimate long-term impact of some of these policy shocks. And then there's pressure on the Fed coming from the administration. So I think the likelihood of a policy error becomes higher in light of all those factors. But I think there's still a good chance that we escape a recession and we just end up with slower growth, equity returns below average, and don't necessarily need to see a crash. The longer this goes on, though, and the more stretched valuations get, the more these imbalances really expand, creates a higher risk that we do experience some kind of big crash in sentiment and a crash in markets.
What are you doing to protect against that? Or are you waiting for more signs that it's coming before you make any changes to reflect that?
So we're active stock pickers, which means we can be selective. And I think we've certainly seen much more exuberance, maybe irrational exuberance in certain segments of the market. So certainly anything AI related has run up in price. And some of those companies, they don't have the real growth prospects to ever catch up with that valuation. So you can avoid some of those really expensive names in overhyped sectors. And then we talked about international at the beginning of this segment. That's a place where it might make sense if you've got some big profits in your US equity portfolio, moving some money to global markets that might have run up, but they started at much lower valuations and they're still trading at lower valuations than the US, despite the fact that they're expected to have faster earnings growth. So that kind of international diversification is a good way to hedge your bets if you've got most of your exposure in US stocks.
Because you are stock pickers and because valuations concern you, are you holding more cash or finding yourself being more selective because you can't find the bargains? Or is it as long as the market is running and we got a decent AI name or whatever it might be, while it was still more reasonably valued, will you let it ride?
We tend not to do extreme market timing. So we're just trying to rotate out of more expensive names, more expensive sectors into, sectors, stocks, regions where we see not just better valuations, but better growth opportunities. I think this is an especially tough time to try to market time by putting money in cash because there is a trend toward higher inflation and as rates come down and there's not as much yield for investors who allocate to fixed income, that gets a bit more challenging. You want to hold assets that are going to keep up with inflation. So I think equities are still a great place to allocate. You just have to be more pickier, I guess, about where it goes.
You talked about AI and the valuations and how some of the companies there don't have the real prospects to make them real. At this point, do you prefer AI or do you prefer AI adjacent?
AI adjacent is interesting because there's a tendency during a bubble, everyone's using that term now, for investors to move from the explicit names at the crux of that theme. So those kind of headline AI stocks to move to stocks that might be one step removed from AI. Memory chip makers and so forth. And so what you can see is a run up in stocks that are AI adjacent. But then I think there are genuine opportunities. When I look at emerging markets, for example, again, going to international markets that haven't experienced as much of a surge on AI, a lot of the companies that manufacture the tech that goes into data centers, those are companies that actually come from markets like Taiwan, South Korea, even Japan, among the developed markets. And so there is a chance still to buy AI adjacent stocks in those markets that might be flying somewhat under the radar.
And are you in the camp that AI adjacent includes things like the energy companies or what have you, because there's so much demand for power? Or are you not giving them credit that way because there's that mixed feeling on that?
Sure. I think that's, within EM, we've seen plenty of companies that, they manufacture parts that go into reactors or power generators. And there's going to be more demand as these data centers expand, which, by the way, that's not something that depends on AI spending continuing at this pace. I think, we're in a long-term secular trend that is going to see more reliance on technology, more reliance on information technology. And so data centers will expand. So yeah, any sort of company that's involved in supplying those industries, that includes material stocks, companies that process rare earth metals that are used in a lot of these applications. So there are a lot of companies that are related to the AI theme where I think investors can still find something of a bargain.
And you phrased it earlier, talking about AI in relation to the internet bubble, et cetera. You, a moment ago, talked about how others seem to be using the term bubble. Are you using the term bubble? Does this feel to you like a bubble? Or does it not actually matter to you because you are an individual stock picker? So the bubble can burst, but it doesn't necessarily deflate every stock that has ridden that wave.
Yeah, I think you hit the nail on the head. First of all, it's very hard to identify bubbles before the fact. With hindsight, everyone feels like it's obvious, this was destined to crash. But I think there are places where I see valuations so stretched, I find it hard to explain. That's not the whole market of risk assets. Like I said, certain sectors, certainly within the crypto theme, I think it's kind of hard to explain the price on some of these coins, but I don't think that applies overall. The economy globally is in a good place. There are some issues with many countries' fiscal situation that need to be worked out. But I'm pretty optimistic about the future for equity investors. I just think investors need to be careful when valuations get this high, when optimism, as you said, it seems like a market that, no news is bad news. That's an environment where you have to be careful. And I think, again, pays to be selective. And so that's why we advocate for active management.
It seems hard to believe that I have spent nearly 20 minutes talking with you about international investing mostly, and we have not used the word war. We'll use the word war in relation to trade wars, but not actual wars. And we have actual wars going on. Why have they not impacted the market more? And is there anything else, or have we seen from a market standpoint kind of the worst that these wars are going to dish out?
It hasn't really had an effect. If you look at your US equity portfolio, when there's conflict around the world, it hasn't had a big impact. If you look at other markets, so if you think about, again, going to emerging markets, Taiwan, when there are episodes of heightened tension between Taiwan, the PRC, we've seen an impact in Taiwan's market. So these are events, looking at geopolitical conflict. It's something that grabs headlines. It has a really salient impact on investors. It creates an impact, but I think very often it's an overreaction. When you think about the real impact to global financial markets of Russia, Ukraine, it's probably a lot less than folks feared long term. And so I think that's why sometimes it feels like we kind of gloss over the geopolitics and this sorts of real war, as you said. But I think that's because investors understand that very often the impact of those things on the economy globally and on financial markets is actually quite muted.
Phil, great stuff. I always appreciate getting a chance to catch up with you. I wish we had a little more time. We don't, but we'll make time down the line to catch up and see how it's all playing out. Meanwhile, thanks so much for joining me on Money Life.
Thanks. It's always fun, Chuck.
Philip Wohl is Chief Research Officer and Lead Portfolio Manager at Rayliant Global Advisors. Learn about the Rayliant funds, their ETFs at Rayliant, Rayliant, Rayliant.com. Up next on Money Life, it's market call time. Ryan Jacob from the Jacob Funds will be here. We're talking tech stocks when we come back in just a moment.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Ryan Jacob, Chief Investment Officer of the Jacob Funds, is here. We're talking stocks. It's market call time. This is the Money Life Market Call. It's where we talk stocks with experienced money managers who tell us how they make their decisions, what they do in their day job that helps them decide these are the things I like, these are the things I dislike, and what they see happening on the market, how they put it all together. And returning to the market call today, Ryan Jacob. He's the Chief Investment Officer at the Jacob Funds, which is Jacob Internet, Jacob Small Cap Growth, and Jacob Discovery. You can learn more about the funds by going to jacobmutualfunds.com. You can learn more about the firm, Jacob Asset Management, by going to jacobam.com. Ryan Jacob, it's great to chat with you again.
Thanks. Great to be here.
We always start with methodology, and I definitely want to address yours because yours has been the same since you were basically the first ever portfolio manager for an internet fund. Precursor to your funds, but I keep having people tell me what we're seeing with AI looks and feels a lot like internet bubble days. So I want to know a little bit about the methodology and what it is that is going to make any stock stand out to you now. But then I also want to find out, are you seeing things that like, hey, I've been doing this. I hate to call you old, Ryan, because you're not. But I've been doing this for a long time. And yeah, I see the similarities in stocks, or I don't see the AI is the next coming of that or not.
For sure, there are some similarities. There's some echoes of that previous period for sure. Our methodology, we do focus on earlier stage companies than a lot of our peers. Sometimes the companies aren't profitable. Quite a few are. And they have very, very large total addressable markets. And that's really been, since we started, kind of our main focus and what's differentiated us from our peers. To me, what's most interesting, and to me, what's a very interesting similarity is As you remember, Chuck, back in the late 90s, when the internet was really coming into the mainstream, a lot of the focus initially was on telecom companies, network equipment, et cetera, a lot of hardware. I don't think it's a coincidence that in this AI cycle we're in, we're seeing the same dynamic happening. We believe that what's going to happen next is similar to what happened with the internet growth, which is that eventually transitioned more into software and services. So that's been our bigger focus right now in trying to be positioned in those companies that are going to benefit from the growth of AI as far as using it for businesses and consumers. So that's where you see a big similarity between kind of the internet boom and what we're seeing here with AI.
When it comes to the characteristics you are looking for, does it mean in the old days, what was really important was always the phrase pure play? You were a pure play internet style fund. A lot of other people were like, hey, this retailer has a website that makes them an internet company. Do you look at AI today and the technology today and say pure play is strictly AI, or is it the AI adjacent? And it sounds like you like AI adjacent better than you like AI.
No, I would say there are plenty of pure play AI companies. The problem is the largest pure play AI companies are private. So the challenge is when you're looking at smaller or mid-sized companies, there are definitely pure play AI or companies that will become or evolve into kind of pure play AI companies over the coming years. We think that's really where the sweet spot is right now.
Are there specific dynamics you are looking for in a tech stock for you to buy it, whether it's valuation or sales, or as you pointed out, profits don't seem to be the big one, but what are the metrics you're looking for that helps you decide this is the one I want to buy and this one, not so much?
It's honestly, it's less about some of the quantitative statistics that you mentioned and more on the qualitative. So you're really looking at kind of which markets are going to develop in a world where everything's interconnected and everything is going to kind of interface with, artificial intelligence. And so for us, companies that are repositories are able to handle unstructured data. One of our larger holdings is a company called MongoDB. Kind of some of the most cutting edge database programs out there are offered by Mongo. Another one might be Cloudflare, which offers edge computing, which was always really important. But one of the problems with AI today and will be is latency. And the fact that they push a lot of the computing out to the edge of the network, besides the security, which is really their main focus right now. But eventually, the ability to distribute that content without the latency that we currently have is going to become just more and more valuable. So those are two examples, and there are a bunch more.
I've had people talk about it that they think, in fact, we had a discussion earlier on this show about whether or not we're seeing a bubble. And you can't really see a bubble until it is bursting. But having lived through the internet bubble then and having pointed out the differences that you see, are stocks in some cases still performing the same? Do you see bubble characteristics in some stocks? And how do you deal with that if you like the underlying, but you're worried about the bubble effect?
Generally speaking, it's kind of unavoidable that when you have like a big step up, the progress of technology, that you're going to have a lot of companies that are very well positioned, very valuable, but you're also going to have a drafting of a lot of other companies, kind of hangers on or kind of pretenders that are looking to benefit from this trend. That's unavoidable. So that's going to happen really with any transition you're having in technology. One of the big differences, as you're well aware, is a lot of these companies are actually profitable today. Much, much different. Back in the dot-com boom, companies couldn't wait to go public, and they went public, honestly, probably too early. In this case, they're waiting as long as possible to go public. So it's a complete 180 from what we dealt with back in the late 90s. And again, you just can't expect, there's going to be some bubble type of characteristics with any big change in technology where, again, you really have to separate the wheat from the chaff. And that's always going to be the case.
One of the things that has helped you throughout your career is that, having struck the internet vein before everybody else, you were a star manager there. We have seen, of course, active management at times being struggling to keep up with indexes. But we've also seen how AI has, and the AI boom has changed some of the indexes, making it that certain things are really dominant. As an active manager right now, do you have to kind of say, okay, I'll have the big players here because I'm in technology, and if I don't ride a little bit with them, I've got a problem? Or do you simply say, I'm going to go my own way and eat my own cooking and not worry about what is happening with the biggest names?
I'm kind of chuckling a little bit because I'm sure, you're aware more than most, but we're in this unique period where you could own a passive type of investment instrument and have way too much concentration, whether it's in technology or individual names. Historically, we haven't seen anything like this since maybe the Nifty 50. I mean, going back literally that far, not even in the late 90s did we see these levels of concentration. So, when we look at the funds we manage, we're not looking to compete against kind of large cap tech ETFs. There are plenty of low-cost product out there for investors to choose from. What we're providing is something more in the smaller cap range, companies that we feel, quite frankly, right now offer some better values, but also give investors diversification. And we think that, small caps have been out of favor versus large caps for so long. And that's why the performance, a lot of these large cap indexes have been so strong. It's been that way really for the last 15 so years, except for a few little pockets. We think that dynamic will change eventually. And when it does, we feel very, very comfortable with how we're positioned. That can offer investors some difference in their portfolio rather than owning a bunch of funds, but ultimately owning the same stocks.
So you mentioned MongoDB and Cloudflare. What's another name or two that stand out to you right now?
Well, so those are two tech specific. The thing is also with AI is it really, and this is the same with the internet. You brought up Barnes and Noble, but it's clearly affecting many different sectors. One of the other sectors that's having an impact and is represented in our portfolio is the real estate industry. Recent holding of ours, Rocket Companies, just went through a few acquisitions. We're very positive on. We've been long-term shareholders of Zillow. These are companies they're implementing pretty significant AI to drive efficiencies in their market. And even though the real estate market, for instance, has been, poor, to be generous, I mean, mediocre maybe, these are companies that once conditions improve, have kind of silently rejiggered their businesses in a way where they're going to be extremely profitable. It's one of these things, again, across many different sectors. We have this is a longer conversation, but the idea that companies are driving higher margins while they're still laying off people and becoming more efficient, it's something we haven't really had to grapple with in terms of trying to analyze, but that's what we're living in today.
And quickly, what makes you sell? What makes you say, I like this, but I can't stay with it anymore?
Yeah, well, obviously we're valuation focused like everybody, but you don't want to be a slave to that because a lot of the companies that we're buying are growing at very high rates, and we can underestimate kind of the adjacent market opportunities they have. So it's something we do focus on, but again, you want to be careful there. It's really if the end market changes. I mean, there's a lot in AI that's going to disrupt certain industries that would cause us to move on. And then also a competitive outlook or anything on a regulatory standpoint. These are things that tend to move us than just solely valuation.
Now we're going to get your quick and dirty take on some stocks that my audience is particularly interested in.
Quick and dirty.
I know you're excited, but calm down and listen to me carefully.
Yeah, well, you want to make sure you're getting the right take, and in today's case, you're getting it from Ryan Jacob. He's the Chief Investment Officer at the Jacob Funds, which is Jacob Internet, JAMFX, Jacob Small Cap Growth, JSCGX, and Jacob Discovery, JMCGX. Learn more at jacobmutualfunds.com. You know how quick and dirty works. Send your requests in. Chuck at moneylifeshow.com is how you do it. We start today with a request from Dave in Jacksonville, Florida, who wants to know about Confluent Incorporated. It's CFLT.
So Confluent's a good example of a definite AI beneficiary that's not a mega cap, large cap name, more in the small mid-range. They do data streaming through Kafka, which is kind of an open source standard for data streaming. And again, when you're talking about AI, one of the biggest challenges is basically streaming your data efficiently over networks and dealing with issues of latency, et cetera. And Confluent is very, very well positioned. It's actually one of our larger holdings.
You need to buy here.
That's buy on Confluent, CFLT. Our next request comes from Les in San Diego. He wants to know about HubSpot, ticker Hubs.
So HubSpot has been around a while. They've built a tremendous business on the marketing front for a lot of companies. Most major, probably Fortune 500 companies use HubSpot. HubSpot, unfortunately, though, we believe is one of those companies that could be disrupted with AI. Anything kind of related to a customer relationship management or that type of marketing is probably most at risk from agentic AI. And so I would steer clear of HubSpot, unfortunately, right now.
You don't want to buy right here, okay? Right?
Yeah, so we started off with a buy, but on HubSpot, HUBS, that's not a buy. That's an avoid or a sell. We'll stay in San Diego, but it won't be with Les. It'll be with Amy in San Diego. She wants to know about Doximity, which is ticker symbol DOCS.
So Doximity, it's a holding of ours. We've owned it for a little while. It really is a tremendous company, some of the highest margins of any company we invest in today. It's kind of like a Facebook for doctors. It's the easiest way to explain it, but they've really, not only is it a network of only licensed doctors, which is very, very valuable, obviously, for advertisers, but the services they provide these doctors are really all of their pain points, whether it's processing insurance, whether it's dealing with inbound calls from patients. They provide all these just invaluable tools to doctors that's just made them kind of far and away the favorite network for any medical professional. And like I said, the margins are really terrific, and they only stand to get better.
That's why we should buy now.
Exactly. And that's why Doximity, DOCS, is a buy. Sam in Waterfleet, New York wants to know about Paylocity Holdings Corp. It's ticker PCTY.
PCTY, actually, we did hold Paylocity years ago, and it's definitely on the cutting edge of payroll processing and a very well-run company. However, I think they're kind of caught in this situation I alluded to before, which is we could be dealing with a situation where we could have a strong economy and a weak employment market. And they're so tied to the employment market, I'd have a hard time being really positive on them here.
Strong employment market, weak market for Paylocity Holdings, PCTY.
Please sell it.
And last, for David in Missoula, Montana, and again for Dave in Jacksonville, Florida, it's Block, which is now ticker symbol XYZ.
Yeah, Block is a holding of ours. You know, it's kind of a two-part business between Square and Cash App, which most people are familiar with. Most businesses are familiar with Square. Most consumers have heard of or used Cash App. We're a really well-executed business. Could be really one of the banks of the future. Could even replace like one of the money center banks going forward at some point. What's interesting in the near term with XYZ Block is they've really introduced credit products to consumers that are really innovative and could be, not only could they be very profitable for XYZ, but also kind of replace what we've had in kind of a payday lender situation where people can get micro loans based on direct deposits or what have you. They don't have to charge usury rates for it to be a wonderful business for Block. And they've seen the last few quarters, it's picked up tremendously. And we think it'll continue for the next several quarters. So we'd be pretty positive here.
Buy it outright.
Yep. Pretty positive means it's a buy on XYZ, Block Incorporated. And speaking of good buys, it's time for us to say our goodbyes to Ryan Jacob. But Ryan, always great catching up with you. Thanks so much for coming back to the show. We'll do this again down the line.
Thanks, Chuck.
Ryan Jacob is Chief Investment Officer at the Jacob Funds. That's Jacob Internet, Jacob Small Cap Growth, Jacob Discovery. Learn more by going to jacobmutualfunds.com. Learn about the firm at jacobam.com. And we'll come back. We'll put a bow on this show, tell you where Ryan agreed or disagreed with some recent guests, and finish it all up in a moment.
Hi everybody, it's Rob Floyd, Money Life's executive producer, and this week we have a contest for Jillian Johnrood's book, Retire Often, which was featured on the September 10th show, right before Chuck headed to FinCon. The book is all about how people can take short or mid-range retirements to pursue their passions and recharge their batteries and change their lives. In the same way that it's never a bad choice to take a break, there are no wrong answers to the contest this week. because all you need to do to enter is send us your 2 most appealing mini retirement ideas. Now, Chuck says you're not allowed to say, "I'd quit my job and do nothing." We're looking for what you would do if you could retire the way John Rood suggests, taking a break for a month or a year to try something new, pick up a new skill, pursue a passion, and so on. Send your most interesting retirement ideas to chuck@moneylifeshow.com. And so long as you have 2 ideas for your next retirement, you'll be entered in a drawing to win the books. The deadline is Saturday, September 27th at noon Eastern Time. Please put the word contest in the subject line of your entry, and maybe your next retirement can start with reading the book you win.
We are back to wrap things up, but as we went into that break,
You made a boo-boo.
yeah, I did make a little boo-boo. I said we had crossover because I was sure we did. And then I went and checked on all of the tickers that Ryan Jacob mentioned in that interview, and there was nothing. I mean, I thought MongoDB would be there. I thought we had talked about rocket companies recently, Zillow. Not in the last 6 months for any of them. Not Block as well. So no crossover from that interview, other than that, of course, it was great financial talk, whether we compared it to anything we had previously as well. Thought the interview with Philip Wool was great today. Again, Jonathan Clements, the tribute is the least I can do, but I am feeling a lot like, wow, there but for the grace of God, because we are similar ages and very similar careers. Tomorrow on this show, Mark Fleming, chief economist at First American Financial, will be here. So that by itself will be great. We'll take a big, deep dive into housing affordability and more, and it will bring up some things like the Paula Pant interview from FinCon, where we're talking about housing affordability and how she measures affordability. And then go back, we had the interview not that long ago with someone who was saying you really don't want to buy a house at all. So a lot of different things there, although that Mark Fleming will take the opposite side of that, because the guy who was talking about renting, not buying, and right now I'm whiffing on his name, he was from a group that basically made multifamily homes and rental properties, et cetera. And Mark is from a company that does mortgage insurance and the rest. So yeah. If you're looking for something to celebrate, well, today is Rosh Hashanah. And for my brethren who are celebrating, Happy New Year. I am celebrating, although it's not stopping us from doing the show. It is also National Teal Talk Day, which is all about ovarian cancer. It is Restless Legs Awareness Day. I occasionally get restless legs, but I also have some things I do to take care of it. So if you're ever looking and things to avoid cramping and stuff along those lines, I've got some solutions that you may not enjoy, but they work. It's Energize Day, like you should energize your life from your within. And then it's National Checkers and Dogs in Politics Day. On September 23rd, 1952, Richard Nixon, vice presidential candidate at the time, gave a speech that's been known forever as the Checkers speech, because he had been accused of improprieties from a fund that was established by his backers to reimburse him for political expenses. He was accused of taking money for himself. He needed to defend himself, or he might have been kicked off the Republican ticket. So he went to Los Angeles and he delivered a half-hour television address, which at the time was the most widely seen thing ever on television. It was heard by about 60 million Americans, which again was the largest TV audience at the time. He said, regardless of what anyone said, he intended to keep one gift from his supporters, and that was Checkers, the black and white dog that he had been given. And that led to an outpouring of support. And thanks to Checkers, Nixon made the ticket, and the rest is history. I'm not going to go into the other history. That's why we celebrate Dogs in Politics Day, or Checkers Day. By the way, it is also National Snack Stick Day. I love a good snack stick. I am surprised that Clements Sausage Company in Milwaukee, which created this in 2016, does not sell direct to the public. So I can't get their stuff here. But if you've got a good snack stick provider, I'm all ears, because I actually am mostly mouth, and I'm happy to eat. It's also National Great American Pot Pie Day. My guests today were Philip Wool, Chief Research Officer and Lead Portfolio Manager at Rayliant Global Advisors, Rayliant.com, and Ryan Jacob, Chief Investment Officer for the Jacob Funds, JacobMutualFunds.com. Learn about the firm at JacobAM.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog, who, like Checkers, is also black and white. But mostly thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Charles Ellis, who's been a guest on the show, who said, first-class investment performance cannot be measured on a quarterly or annual basis. Outstanding investors don't work that way. It's worth keeping in mind as you hear things about whether or not we're going to change quarterly reporting, but you want to keep everything in perspective, and that's why you want to remember, until we do this again the next time, best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again on Money Life tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
In the end, it turns out it wasn't about the money after all.